The institutions are dumping not only stocks, and they have been, which is a continuation from last year, but we are seeing a massive dumping of U.S. treasuries across the board. And how much of it is due to our perception around the globe? I think these are all very important things to think about. So when we talk about managing perception, it doesn't really, I think, it's not a huge stretch to think that they really wouldn't want to see gold and silver taking off right now, going through the roof, and the dollar getting crushed in the midst of this, this event we see going on in Iran. So the deliveries are betraying the price.
Gold's pullback has prompted investors to question whether the metal still deserves its reputation as a safe haven asset, but UBS said in a note Tuesday that the core thesis remains firmly intact. According to UBS, the factors that have underpinned gold's bull run are still in place, with rising investor allocations expected to drive new record highs this year. Renowned expert and precious metals analyst Andy Schectman emphasizes the recent pullback in gold and silver is a normal part of a long-term bull market and does not signal its end. According to him, current conditions may even suggest the market is oversold, which historically often precedes a rebound. Schectman also suggests that gold and silver prices can be influenced by efforts to manage the perception of the dollar, while physical demand continues in the background. In his analysis, Andy Schectman says that record institutional selling in equity markets, particularly massive liquidations of S&P futures, signals a shift away from traditional assets as confidence in fiscal policy and financial stability weakens. He explains that global investors are increasingly questioning the reliability of U.S. assets, including treasuries, amid rising debt, policy concerns, and geopolitical tensions. Moreover, Schectman also highlights a major divergence between paper prices and physical demand, noting that unusually large amounts of gold and silver are being withdrawn from exchanges like COMEX. Millions of ounces of silver and significant gold reserves are being taken into physical possession, which shows that large, sophisticated investors are prioritizing real assets over paper exposure. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Andy Schectman's recent interview.
I think this is normal. I think the bull market is far from over. And, it was a breakout of a 45-year consolidation pattern that doesn't end this short after it began. It's just shaking out some of the weak hands, and I expect this to be the standard operating procedure moving forward. And I think this is why you see not only an entire school of investment theory called wave theory, Kondratiev and Elliott wave, speak to the cumulative emotions of the masses, of the public, but it's also why so few people are ever able to succeed in investing, because no matter what they say, their emotions just seem to grab a hold of them. You can be someone who prides themselves at being logical and seeing the technical side of things, and then seeing the counterintuitive nature of war breaking out and discord around the globe and all the problems that we see. And why aren't gold and silver reacting the way that logic would dictate? Jared, it's because of something that my dear departed friend Jim Sinclair used to say. He called it MOPE, M-O-P-E, management of perception economics. It's very important to manage the perception of the dollar and of what would be the inverse correlation to the dollar, price of gold and silver. And as these prices are being managed to a degree, there's a lot of deliveries that are taking place at subsidized prices. So to me, it isn't anything other than what we should expect. This is not the end of the bull market, not even a little bit. And we haven't seen anything that would make me feel that it has substantially broken down at all. In fact, you could argue that it is massively oversold. And if you look at previous examples of it being this oversold in the RSI, it usually we're right at that point where it starts to move in the other direction. But markets can stay oversold or overbought longer than people can stay rational, solvent. What I meant was they can stay irrational longer than we can stay solvent. But anyways, yeah, it's fair to feel this way. It's okay to feel this way, but try and separate your emotions from what we see happening in reality. And I think it might be a little bit easier but no one ever claimed it would be easy all the way around. Record liquidations. Institutions just sold the most S&P futures ever, specifically during March 3rd and 10th. Asset managers sold $36.2 billion per commitment of traders, making it a 10-plus year record in notional terms. So you're seeing institutional traders move away from the equity market. You see great irresponsibility in our fiscal policy, a lack of unity in this country that is making I think people question around the globe the wisdom of holding treasuries, of holding our assets when we go around the world with a stick instead of in a cooperative manner. And they look back at this country and say, they're disconnected. They are not united. They are fiscally irresponsible. The institutions are dumping not only stocks, and they have been, which is a continuation from last year, but we are seeing a massive dumping of U.S. treasuries across the board. And how much of it is due to our perception around the globe? I think these are all very important things to think about. So when we talk about managing perception, it doesn't really, I think, it's not a huge stretch to think that they really wouldn't want to see gold and silver taken off right now, going through the roof, and the dollar getting crushed in the midst of this event we see going on in Iran. So the deliveries are betraying the price. And again, just the other day, what did we see here? Last week, we saw so far, this would have been last week, I believe, 104,844 ounces of gold shipped out. They're called physical loadouts. It's independent of the deliveries. So we see almost 105,000 ounces of gold get shipped out last week. We see 2,944,000 ounces of silver shipped out last week. And, I think when you see 2.95 million ounces, actually, it was in a single day. This might have been on Friday. 2.94 million ounces load out in one day. Not only is it not normal, that's not business as usual, and it doesn't really say that the market or the COMEX market is broken. But what it does signal is that really, really big money wants to have physical possession of metal, of both gold and silver. 3 million ounces moving out in a day of silver. Who's taking possession of that? We saw in the month of February, 38 million ounces leave COMEX of silver, leave COMEX. This is independent of all the deliveries that are coming in that stay within the ecosystem, typically in the eligible category. But this is a trend that I think betrays all rhetoric and all the mainstream narrative, is that some very sophisticated money is finding not only refuge in gold and silver, but removing it a la no counterparty risk from the ecosystem. So these are things that I look at that make me say, well, price is obviously relevant, but how much of it is used as a tool to misdirect? And I think that's really kind of the issue here, is that this to me is something of a misdirection more than anything. And here's a chart that I wonder if I can blow this up. You see that?
Yep.
That's oversold territory. That's where we are. And so when you talk about being in that oversold territory, typically when it reaches that line, we end up seeing a bounce. So, I think we're close to seeing a bounce. But again, corrections and volatility should really be expected in this market. These are very high stakes that we're playing for. And I also look at another interesting thing too. There was a report by the Economic Times, and the commitment of traders is beginning to show it, that most of the U.S. banks are relatively long. And in the metal that came out just the other day, on Friday, there were 802 silver delivery notices. And every single one of those deliveries came from Citibank. Citigroup. They were the only one to make the delivery. So it was 8,108 contracts through March. That's 40.54 million. Now, that's not just Citibank, but Citigroup's house account issued 802 silver delivery notices Friday. They were the only ones to do it. And so 802 times 5,000, and they sent them out to all the big banks. And the caption that I saw on X was, is Citibank the last U.S. bank to be short? You're beginning to see, by all accounts, some of these big banks that have been really at the forefront of stepping on the paper price, by all appearances, beginning to move into a net long position. So hang tight, hold on tight, don't let go. I think you'll be glad that you did.
Regarding rising market instability, Andy Schectman notes repeated glitches in COMEX and London Bullion Market Association are becoming increasingly frequent, signaling unusual stress in the system. He explains that the LBMA's over-the-counter structure leaves it more exposed than COMEX, especially as settlement delays stretch from days into weeks. The widening gap between massive paper contracts and limited physical silver supply is becoming harder to ignore, warning that rising demand for real delivery could expose structural weaknesses. According to him, these disruptions and suspensions are damaging market credibility and may indicate that pressure is building beneath the surface, with potential for significant shifts in the metals market ahead. These disruptions, combined with rising physical withdrawals, indicate that large players are quietly moving away from paper markets and securing tangible assets. Andy Schectman suggests that what appears to be coincidence may instead reflect deeper systemic strain, where an over-leveraged system is being gradually pressured by growing demand for physical metal, potentially setting the stage for significant market shifts ahead. Let's jump into the interview.
On the downside, we saw both times the price got clubbed about a month ago. Well, the circuit breakers glitched. Sorry, they didn't work both times, and the price cascaded instead of stopping for cooler heads to prevail. About a week ago, we saw the market glitch again as the price was spiking, and they said, and they threw in natural gas for good measure, just to kind of throw it off the trail, throw us off the scent, if you will. But yeah, sorry, we've had a glitch in the servers again. I don't know how the hell that happens. 4 glitches on the COMEX. Well, today, the LBMA. Now, I've been very vocal about the LBMA, and I had David Jensen on my show. And David is an amazing guy who does a good deal of research on the LBMA. And he's talked at length about, 2 billion ounces in open contracts that could stand for delivery against about 140 million ounces of silver that could be delivered against those. We've talked about most of last year how the LBMA is the oldest metals exchange in the world, 140 years old, that they're a T+1 settlement market. It's really not that complicated. It means T is trade day plus 1 is settle. On the third day, the bar should be on the way to you. For a good portion of last year, they said, we have a shortage of manpower and trucks. It's going to be T plus 8 weeks. So we're supposed to believe the Bank of England doesn't have the wherewithal to be able to get trucks and hire people to move bars. It takes 8 weeks instead of 1 day. Now, if you have a legitimate fabricating business, you make jewelry or whatever, you may have a big problem with being told that your plans have been derailed for 2 months. I've always thought that the problems would happen there before COMEX, because COMEX is an exchange, and the exchange has rules and things in place like force majeure, cash settlement. If things start to get out of hand, they will protect the exchange and its members largely. The LBMA is not that way. The LBMA is a over-the-counter exchange where there still are rules, but there is no exchange to come in and save you. In essence, you have to abide by the cooperative rules of the exchange. But if I have a seat there and you have a seat there and we trade with one another, well, that's on us, and there isn't an exchange to come in and save the day. If one of us gets in trouble, it can put you out of business. Well, guess what happened today? Some form of a glitch in the LBMA. And now, at first reports, they said it was some trading. Last I heard, it was all contracts on the LBMA have been suspended. Don't know what's going on there, but you can look at India as an example, who not too long ago came out and said, we want to stop using the LBMA as benchmarks for our gold ETFs and want to tie it in more to our own domestic spot price, spot market. To me, that speaks of the LBMA has lost credibility. And you can see that in what's happening. You can see it very easily over the last year. And David Jensen does a magnificent job of doing that. But This happened today. The London Metals Exchange has temporarily suspended trading in several important metal contracts. The operational decision affects one of the world's major commodity exchanges through those specific details about the affected contract's duration and underlying reasons for its suspension have not been discussed or disclosed. So, you know, is this desperation all around the globe in the Western markets in the way that they price things? We've always talked about the potential for something like this to happen. Is it smoke? Is there fire somewhere, a spark? I don't know. It just seems, the old adage, fool me once, shame on you. Fool me now 5 times. You're an idiot if you don't think that this is normal. It's not normal, and it reeks of desperation. And, I'm not trying to find a hidden conspiracy theory, but, what does Occam's razor say? Okay, this isn't just coincidental now 5 times. No, granted, this is the first I've seen in London, but we continue to see great acts of desperation right out in front of us and right out in the open that are claiming a different narrative. But, how plausible really is that? And is this over leveraged system that we've talked about for a long time that many in the world see clearly are trying to exploit slowly? People say, well, why don't they just buy it all up? Because just like that, it's over. But they've been cutting us with paper cuts every single month for a long time, and it's beginning to really show strains. It's the delivery. The deliveries are what is changing the game. Nobody ever stood for delivery in London, or very few, and in the United States. Small amounts. Now we're seeing large deliveries, and that's changing the paper game. It's just like Bernie Madoff, everyone was getting their checks. He was stealing from Peter to pay Paul. That was great. But when Peter and Paul said, by the way, I need my original principal back, I need to move on to greener pastures, well, that became a big problem. And maybe that's what we're seeing here. But I just think to see it again, this is the 5th instance, first in London, 4 in the US, where we've seen disruptions in a market that deliveries are far delivery requests and open interest are far exceeding bars that could do it, could be delivered. So is this, management? Sure seems that way to me, but either that or it's one hell of a coincidence, I guess.
Precious metals' sharp sell-off in early February 2026 was triggered by a stronger US dollar and profit-taking after the metals hit record highs. However, many analysts view these corrections as temporary pullbacks rather than a trend reversal. As physical withdrawals accelerate and systemic pressures build, the foundation appears to be forming for a stronger and more sustained move higher in the years ahead. Will investors recognize the shift in time and position themselves in physical gold and silver before the next major breakout begins? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.